Ladies and gentlemen, welcome to the Motivate Property Podcast. It is Friday, the 25th of July, 2025. Hope everyone out there is having a fantastic week. So guys, this week we are running through the market updates for the second quarter of 2025. Now what we're going to do is have a bit of a deep dive and have a look at what the market's been doing nationally, look at the data, look at the evidence, look at sort of what the push and pull mechanics are doing, just so that, again, you guys can have more informed decisions into your decision making and buying and investing over the next 6 to 12 months, right, as we sort of move forward. Think of this as a guide, right? So don't take this with, an absolute gospel, take it with a pinch of salt, and I want to sort of explain why. And keep in mind, last time I did this, towards the start of the second quarter, so about 3 months ago when I had this conversation, did this podcast, I had a few people, let's just call them trolls online. You got to keep in context, guys, this is a guide, right? This is not the specific exact figures of what the median prices and median rents are doing. Why? There is no such thing of actually being able to work it out exactly, right? So when I go through this data, you got to keep in mind, I'm using RP data, which is a Cotality. Now they've just rebranded. Realestate.com, Domain, ABS data, PropTrack. There's a number of different research and data suppliers that we're essentially getting this information from. You got to remember, they're all different, right? So if you go to Domain, you go to realestate.com, they're going to give you different data when it comes to median house price. So really the idea is this is kind of give you a guide of what they're all kind of saying. Like I said, there was a couple of people like, oh, the median house price is wrong. Well, that's because you can't actually measure what the median house price is because the market's continuously changing, right? So like I said, I just want to provide that a little bit of context. Now, before we get into the actual content, the other thing I think is probably worth mentioning here is why the data is different, right? So just so, for example, when you go to Domain versus Real Estate versus, say, REWA, you go to the ABS, you go to PropTrack, you go to all these different, SQM Research, CoreLogic, they're giving you different data because they're taking different measurements. So firstly, the first question is how is their timing when they're collecting the data? So for example, some of the researchers, and some of the sources look at data from a weekly perspective or a monthly perspective. Some do it quarterly, some do it annually, right? So when they're saying, hey, this is the median house price of your suburb, you've got to understand that the actual overall times that they can differ, and that causes slight variations in the results. Secondly, when it comes to things like the scope and coverage, right? So as an example, and obviously we're based in Perth, so I'll give you the example for Perth. But, the question is, where does the metro area of Perth, where does it end? So again, right now, you've got places like Yanchep and Two Rocks at the very top. You've got places like Dawesville and Pinjarra down the south. Some of these suppliers don't count those as suburbs of Perth. They count them as rural. Whereas the bigger data sets are really collecting, including those suburbs, into the actual mix of what the Perth metro area is. But again, that's continuously changing because obviously Perth size and urban sprawls are just getting bigger and bigger over time. So the fact of the matter is, what they consider the Perth metro will differ from site to site. That creates differences in the actual numbers themselves. The other thing to consider is what are they actually measuring? Some are talking about units, some are talking about houses, some are talking about all property transactions, some only look at existing dwellings that are sold on the established market, some also include land, and then they look at components of the building. The problem is the building is its own separate contract, so it doesn't record it on things like Lang and CoreLogic. So again, that can cause some difference in the measurements and how they're essentially doing things. So like I said, guys, this is to give you guys a bit of an overview in terms of a rough guide as to where the market is. Treat the median prices and the rents, take it with a pinch of salt, I guess is where I'm going with this, right? Multiple sources, look at multiple sources. We use multiple sources. So it's not like we're just relying on just RP data or just realestate.com. We're looking at all of them. And the idea is if one of them's saying, 850, 875, 900, I'm going to give you guys a rough guide around 875, meeting in the middle, right? Just to kind of give you an understanding as to what data I'm presenting today. Now, the other thing to consider as well, every independent market is different. Every suburb's going to be different. So, for example, there are some suburbs, there's no infrastructure spending happening whatsoever. There are some suburbs, there's infrastructure spending, for example, schools being built, hospitals, houses being built. You got to remember, the houses that are being built in that area are going to skew this data. You also got new suburbs, old suburbs, premium suburbs worth over $2 million. You've got suburbs that are really cheap, under the $700,000 mark. So the thing to consider, and really what I'm trying to say here is when you go to CoreLogic, Domain, Realestate.com, ABS, PropTrack, all these information sources, you've got to look at the data collectively. Not a single researcher or data analyst can give you the exact figure as it is today that's 100% accurate because the market's continuously moving. One other thing to keep in context here, property is very slow to transact. So if I was to buy a house today and give you an offer today that you accept today, I've got roughly 4 to 6 weeks to get through to finance, roughly 2 to 3 weeks to get through to settlement. So by the time that it's registered with Landgate in, let's just say, 2 or 3 months' time, you got to keep in context, that was today's price in 3 months' time. That lag or that delay can also cause huge variabilities in the data that I'm going to present, right? So like I said, I just wanted to lay that as the context for what I'm about to say. And like I said before, take it with a pinch of salt. Do your own research. Don't just rely on what I'm saying or believe what I'm saying. As much as I am trying to give you guys the accurate information and the accurate sort of perspective, let's say, the fact of the matter is you got to do your own research, right? If you were to make a bad decision based on what I'm saying, that's on you, not on me. So like I said, take this with a pinch of salt. Now, for the overall market, right? So let's just talk about Australia as a whole. And now, like I said, we're on the 25th of July, 2025. A lot of the last quarter data has come out. So now it's time to sort of run through what that data looks like. Now, firstly, the national housing market. All 8 capital cities have recorded growth for the first time in 4 years. Now, keep in mind, what I'm essentially saying is that's every single city has grown in value. Now, oftentimes what we're seeing over the previous years, we might, for example, Perth booming really well or growing really well, but then, Adelaide or Hobart might be coming in and that kind of variability. What I'm essentially saying here, this is the first time in 4 years that the entire market, all 8 capital cities have grown in value. Now, the question is why? Right? One of the main things that's happened is the fact that the interest rates are starting to come down. So that's just freeing up money. All that means is interest rates come down. The average mum and dad out there or average person out there who wants to buy a property can now go and borrow more money. Now they can now start servicing more debt. That's created a little bit more of a demand. And then obviously supply and demand, property prices have gone up. Now the national growth year on year right now is 4.6%. So that means the overall market year to date has grown at 4.6%. Now, what we're looking at in terms of the projections between now and the end of the year, KPMG, these guys are forecasting around 3.3% house rise and 4.6% in units over 2025 as a whole. So considering the fact that we're sitting at 4.6 just goes to show that we're actually kind of beating their projections. Domain is also forecasting that the national price will grow between 4 to 6% by the end of the year as well. So that's looking like we should sit around, if we average that and kind of stack them, we should be sitting around that kind of 8 to sort of 12% by the end of the year nationally. That's the national median house price, every city bundled into one. Now, having said that, when we look at the actual overall cities, so firstly we got Sydney. So Sydney's median house price is bouncing around that $1.3 million mark. So that's grown at around 1.3% year to date. So that's from January to today. Now, again, that 1.3, you go to 3 different websites, they're bouncing around high 1.2s to the low 1.4s, roughly sitting around that 1.3 mark. 1.3 million, that is. And yes, 1.3% growth as well. So that's why, that those two numbers are pretty similar. Melbourne is sitting around the $800,000 mark. So again, it was sitting in the high 7s to the low 8s. So it's sitting around that kind of 800 grand mark, depending on who you're looking at. They've actually experienced a slight decline, 0.4%. That's the year to date. Right? So that's just from January to today. Now, when I was giving the overall data before of saying all the cities have grown year on year, that's the last 12 months. This data I'm showing you right now, where Melbourne's gone backwards by 0.4%, that's just the last 6 months. So again, means it's increased in the last 6 months of last year and it's slightly decreased this year. Now, Brisbane is sitting around 930,000 median, which has grown by 7% since the start of the year. So that's they're on track to basically perform twice as strong as most other cities around the country and the national median. Now, one of the biggest drivers in Brisbane is the fact that there have been a lot of interstate migration from Melbourne and Sydney moving into Brisbane. So that in itself has caused a lot of growth. Keeping in mind, Greater Brisbane population has grown by 9.2% over the last 4 years. I'm going to show you guys, and I'm going to run through some of the population growth stats in a second, but 9.2% over a 4-year period, that's obviously averaging over 2% per year. That's actually pretty bloody big. And I'll show you some comparisons in just a sec. Boost in population for Brisbane and the fact that the housing market and the housing supply hasn't kept up, that's why the housing market is still continuously growing, right, in Brisbane. And obviously the fact that they're sitting at 930, which is just above the median house price for the country, and the fact they're not slowing down shows that it's a very desirable place to live. And obviously, for those who do live in Brisbane or have been to Brisbane, I love Brisbane. It's beautiful. It's nice and warm. Now for Perth, our median house price is sitting around 820,000, which has grown by 7% this year alone as well. So again, if we just assume we're going to do the exact same thing at the start of the year, at the end of the year, we'll be sitting around a 14% growth rate. Adelaide is a little bit more expensive, sitting around 840, so it's had an 8% growth. Canberra is sitting around 855,000 as the median, which has grown by 0.3% since the start of the year. We've got Hobart sitting at 680,000. That's also grown at 6% this year. And then Darwin sitting around 540,000. Now, obviously, Darwin is a giant country town, maybe a slight stretch, and sorry for I'm offending anyone in Darwin. Probably shouldn't be offending you, but if that offends, I apologize. They've sat at a 6% growth rate, so that's pretty good. So considering Darwin doesn't have a huge surge in population growth over time, the fact that they're the cheapest city, even though, yes, they are far north and obviously the conditions up there are a little bit different to most other places around the country, the fact that they've grown at 6% just goes to show the overall supply and demand of the country and really where we're sitting. Now, when it comes to rent, all right, because obviously we're talking about prices, now let's talk about the rents. So in early 2025, in terms of rental inflation, so the national median weekly rent has reached $630 a week. All right, so that's 5% year on year. And most of the capital cities, so capital cities alone, it's sitting at 650. So a little bit higher than the national average, because obviously if we look at just the cities, more people there, obviously more supply and demand. SQM research. Sydney's median rent today is $852 per week. Melbourne is sitting at $654 per week. Brisbane is sitting at $689 per week. Perth is sitting at $658. So Perth is actually more expensive in terms of rent. Melbourne, Brisbane, and Adelaide. And then Adelaide is sitting at $622 a week. So the overall rents have also been increasing. And again, it's not so much a function of interest rates right now. It's more of a function of supply and demand. We just don't have enough houses, too many people. I'm going to show you some data in just a second to sort of explain in full. But having said that, considering that the average rent normally tracks around 6% per year and we're sitting at around 5% year on year, I will assume that it hasn't grown at the same rate because interest rates have been coming down a little bit. So that's kind of absorbed and taken some of the pressure out of the rental market. Because again, people can now afford to go and buy their own homes. But the other thing to consider as well for landlords, if your mortgage repayment has just come less, you've got a lot less pressure to be putting up rents. In fact, there is an argument you can put them the other way. All right. So that's the rent prices. Now, unit rents are outpacing houses as well, especially in the cities. And that's something that we do normally expect at this point. The overall vacancy rates is 1.3% around the country. So that's the average for the nation. Regionals are sitting at about 0.9, but some of the metro cities are sitting between 0.3 and 0.7. So that's extraordinarily low vacancy rate. So right now, all it goes to show is there's a lot of demand, not enough supply. Too many people are looking for rentals. Vacancy rate we've got is roughly about half or just under half of what we would normally expect in a normal buoyant market, right? So again, it just goes to show we need way more houses. Now, the annual growth expected in rent between now and the end of the year is sitting around another 3%, 3 to 4%. That's from KPMG. Just again, that's looking at the annual rent growth met between today and the end of the year of 2025. Now, when it comes to the supply of houses, this is where it gets a little, we're going to take a bit of a dark turn here, right? So building approvals were increased in May. This is just after, obviously, we had the first interest rate drops. And keep in mind, in May, 15,202 dwellings were approved. However, right now, the delivery gap from the ABS is showing that we are under around 4,000 homes per month per state as an average. So that's friggin' huge, right? So the Urban Development Institute of Australia, UDIA, warns that by 2029, if we continue at the current pace, we're going to have a shortfall of another 400,000 homes on top of what we've already got today. Now, for those who are sort of paying attention and listening to me for quite some time, I have some solutions to this problem. And yes, relying on the government to supply these houses is not the solution, right? Despite the fact that that's what the media is telling you and what the Labor government is telling you. Now, the fact of the matter is, I did a conference the other day, the Property Academy Council, and it was talking about the future of building in Australia and really the state of the construction industry. Now, to put it plainly, the construction industry is in a world of hurt right now. All right, it is in some serious friggin' trouble. My first piece of evidence is the construction prices have almost doubled since pre-COVID. So just in the last 6 years, the price of construction has almost doubled. The question is, well, why has that happened, right? And there's a few reasons for it. So firstly, we have a substantial lack of skilled workers here in the country. This isn't isolated to WA, this is the nation as a whole. We don't have enough skilled plumbers, sparkies, builders, brickies, you name it, carpenter, all the rest of it, right? The fact of the matter is, And particularly in WA, because WA is probably a little bit worse than most other places around the country because we've got our mining sector. And our mining sector, particularly when we're in the construction or shutdown phases of our mine sites, it requires a lot of skilled workers to go up north and build out those mine sites and deconstruct them. Now, having said that, obviously WA's economy and a huge portion of our exports come from our mining industry. So that puts a lot of pressure on our workforce down here in Perth. Because the fact of the matter is, we've got X amount of tradies. If half of them are going up north because obviously they can earn way more money because there's a lot more demand up there than there is down here, well, it makes sense that we're going to have a shortage of skilled workers. Now, the government's angle to try and combat that is to obviously increase migration. I believe they should be really focused on high-skilled migration, but again, whether that's the case or not remains to be seen. The point is, we need houses. Like, we need a lot of houses being built. First, we don't have the construction workers or the skilled workers to complete that. In the last 10 years, the average price of building materials has grown by 53%. So that's your timber, that's your bricks, that's your cement, that's all your different fixtures and fittings, like everything, all your overall materials to complete a home has grown by 53%. The supply chain is also in some trouble, right? And this is not just any particular item, whether it's timber or steel or whatever the case is. This is overall, right? Now, there is an argument right now, the fact that we are the ones who produce a lot of the raw materials and then export around the world to get produced, there is an argument that we should be producing in our own country. Now, obviously, that doesn't necessarily bring prices down, because if we've got Australian workers in Australian working condition, getting paid their super, taxes, all the workers' comp, all the rest of it, obviously the price of the produced goods is going to be a lot more than, say, for example, the current slave labor in China. Our supply chains really need some work. They really need some support. It's not just a case of the workers, it's also the supply chains for the raw materials. Now, one of the interesting stats that I've seen this morning was the construction timeframes on average in 2015 was 8.5 months. Today, the average is 12.7 months. Once again, we've got a huge undersupply of tradies, a very volatile supply chain market in terms of the raw material. In turn, it's increasing timeframes. We've got ourselves the perfect trifecta of pressure on the construction industry to output the amount of homes that we need. And the fact of the matter is, no one really wants to build a home nowadays for some strange reason. Might be to do with the fact that it's way more expensive, an argument that it is extraordinarily unaffordable, and the time frame is a lot longer today than it was, say, 10 years ago. That may have something to do with it. All in all, we need some real high-level support for our construction industry if we want to get through this. Now, again, let's assume that we're not going to solve this, because I don't think right now government's plans that we're going to solve this. If they were to incentivize private investors like us to go and solve this problem, we'd fix it pretty bloody quick. Let's put some incentives in place. Let's get some things on the ground and get some insulation around the skilled worker supply chain and the material supply chain. But we can fix this. There are ways to fix it. The government wearing the hat called, we're going to go and build all these homes for the people, I think is extraordinarily naive, and it's failing. All right, it's failing year on year, right? I mean, I've been having the same conversation for 2 years. I feel like I'm going freaking crazy talking about this, but the reality is, the government can't fix this shit. There's just way too many houses. There's way too many people. There's way too many that they're required to do. If we sit here and just wait for the government, all that's going to happen, the population will continue to explode. We will continue struggling supplying the housing market with the right amount of houses that we need. House prices will continue to grow and grow and grow way out of control. Now, I'm sitting here as a professional investor thinking to myself, if that happens, I'm going to become extraordinarily wealthier. But I also believe that we should have a balanced market. I think a healthy market and a balanced market is better for everybody. I don't think it's particularly good for society if we just have these growth rates continue to fly through the friggin' roof because we're not paying any attention to fixing and solving the fundamental problems of the fact that we've got not enough skilled workers, we've got serious issues with our supply chains, which in turn is causing more stress, more pressure on the overall market, and it's pushing people away. And so, like I said, that's pretty much what's going on overall today in 2025 when it comes to the construction market. Now, when it comes to population, so this is straight from the Australian Bureau of Statistics. Keep in mind, this came out in June, but this is based on December's data, right? So we had a total population growth of 445,900 people, right? So that's just under 500,000 people came into the country last year. 105,000 of that was natural increase, that's births versus deaths, and then 340 of that, so basically 3/4 of that came from overseas. That's overseas migration. Now, WA had the strongest percentage at 2.4%. Queensland and Victoria had a growth rate of 1.9%. So they came equal second in terms of the growth rate percentage. So that goes to show that WA, Queensland and Victoria, they are primed to have the strongest demand across the next, say, 12 months based on the fact of where they've grown in terms of population. Surprise, surprise, they're also 3 cities that we're recommending for investment. So there are a few different policy changes and things that are coming down the pipeline. For example, one of the things that's happening is a 2-year ban on foreign purchases of existing homes. Again, I don't necessarily think that's a good move because right now we need more houses, not less houses. That's just disincentivizing overseas people to come and help supply houses. There have been some increases in the Help to Buy schemes, particularly with the government helping out, things like the co-ownership or the shared equity scheme. So there are a lot more incentives and bonuses nowadays than there really ever has been. The $1.2 million National Housing Accord targeted homes by 2029. One of the things they're now talking about is using prefab and modular funding for like tilt panel SIP homes, right? So, they're essentially like foam panel homes, right? Do we want to have a future where our homes are built from foam? That is the question. Yes, they are structurally engineered. They do stand the test of time, as they say, and they quote it, they're tested, Australian standard. There's a lot of stuff that they're saying in terms of, it's going to work and, it's legitimate. However, if we don't fix the market and we don't fix the supply chain issues, and then all of a sudden, the only solution that we have is building houses from foam, we have made some serious fucking mistakes. Like, we have made some serious errors when it comes to the planning, the town planning, and the overall direction that we are going as a country. Now, let's just fast forward this 20 years. Let's just assume this happens tomorrow and it takes effect, the best thing ever, right? Fast forward 50 years' time. I'm going to assume that there is going to be a premium on double brick homes versus, say, for example, modular, prefabricated tilt panel home made out of foam. I don't think using modular, prefabbed, these types of dwellings, I don't think this is a good long-term solution as a way out of this. I feel like this is a major Band-Aid solution. Look at how many times we have given a Band-Aid solution to something in terms of policy, right? And when I say we, I'm talking about the government. Every time they provide a Band-Aid solution, it has made things worse down the track. Now, to be clear, the reason why we're having this conversation today about how fucked the construction market is, a lot of it has to do with the fact of what happened during COVID. The government printing more money, stimulating the market, keeping the market moving, keeping people employed. Inflation ramped through the fucking roof. Like, there was all these things that happened, huge pressures on supply chain. There was a bunch of things that happened left, right, and center. Today, we are still feeling the negative impacts. In fact, it's getting worse because of the stacking of Band-Aid solutions upon Band-Aid solutions to get us through that period of time. So to sit here and try and convince someone like me that prefabbed, engineered foam panel homes are going to be the thing that's going to get it out of this mess, I think you're absolutely freaking insane. All right? There are a lot of people in this industry, and I'm talking about construction, who are looking at this with dollar signs in their eyes and don't really give a shit about the future we're walking into. They just want to make money today, right? And this could be a way for them to make a lot of money. I'm very skeptical that this is the best long-term solution. Just as skeptical as I am with battle-axing properties, right? If you've got a big block with a little house on it, to go and build a house in the back of your house, I don't think that's a really good thing for us to be doing long-term at scale. I think that's a Band-Aid solution that, sure, it might make some people some money now or get them out of a sticking point today. But to sit here and tell me that battle-axing is the best way to do town planning in the future, I think it's a Band-Aid solution. I think you're insane. There is obviously quite a bit of investor activity happening at the moment. It is increasing thanks to the interest rate declines. However, we're also seeing something that we do see in this period of the phase when the markets, we do see a lot of FOMO, right? So that's fear of missing out. So auction rates and clearance rates are really high. The investor share of new homes are rising, so from 28% to 37%. So this is just going to show that the market is getting re-stimulated and people want to start buying in because they can afford it because of the interest rates and because they can see prices moving. There is a lot of frustration though, right? So the other part of the sentiment conversation is the fact that there is a shitload of resentment and bitterness in the market because people are putting in offers, $30,000, $40,000, $50,000 and they're still losing and they're doing that over and over and over and over again. I mean, we've got a couple of clients that have come and seen us recently where, one in particular was Aaron chat to the other day. He's put offers on 9 different properties. He's kind of given up, hence why he's coming and using us, and we're going to sort of do it for him, right? But the fact of the matter is, more people are now opting to rent vests somewhere they can afford that doesn't have a stupid level of FOMO and people like scrambling and overpaying for property. So there isn't as much of a necessity to be right in the hub of the CBD, right? So that's one of the trends that we are seeing. Now, when it comes to the overall global risk, right? So obviously one of the big topics we've had over the last 6 months is the tariff wars in the US, right? So that's Donald Trump, aka the Orange Man, I like to call him. So obviously we have seen the headlines of the Israel and Gaza war. We've seen the headlines of the Ukraine-Russia war. I mean, I saw was it Pakistan and India was starting to fire missiles. Last night I just saw Thailand and Cambodia starting to fire missiles at each other. Obviously, this is causing a little bit of anxiety for the average person. Keep in mind, there are still a few people waiting to see before they jump into the market, right? Particularly around what's going to happen to the stock market and really what's going to happen at the effect of the US tariffs. I personally don't think that that's all that relevant when it comes to the overall market, particularly in particular markets. However, it is still making a difference to sentiment. So that's consumer confidence. So that's how confident people are about the economy and their money and how safe they think their money is in the market. So that does play a lot of the role in terms of where we're going. But it's just one of those ones where I think it's good to be aware of it. I wouldn't use the tariff wars and what Donald Trump is doing as a means of you staying out of the market. Like, I just wouldn't. You might be shooting yourself in the foot if you do that, right? Because the direct correlation between what tariff is on, say, for example, US beef this morning, that's not really going to do much to the house prices in, say, Gosnells, right? And just as a simple way to put it. So overall, in terms of the overall takeaways of today, right, and really the market updates. So firstly, the overall market is growing. The entire Australian property market is growing. The major cities of Perth, Brisbane, Melbourne, and Adelaide are growing the strongest. They've also got the strongest population growth. We have a huge amount of supply constraint across the board, and that's new construction. So obviously the supply chains and the skilled workers, we don't have enough of. We don't have enough houses because of that. Rents are increasing. Rental stress still remains high with really low vacancy rates. So people are still scrambling for rentals, but the actual overall pace of the rental increases hasn't been as strong. And when it comes to the overall support from the government, they are helping first-time buyers, low-income earners through Help to Buy schemes, shared equity schemes, and things like that in terms of those grants. However, their overall policy of them being the saving grace to come and build all these houses is just absolutely naive. It's going to go nowhere like it always does. So that's pretty much a bit of a wrap-up of where the market is today in 2025. So thank you all for listening. Like I said, this is 25th of July, 2025, and we've just finished the second quarter of 2025, about to enter the second half of the year. I'm pretty confident that what we've seen in the first half of the year is only going to increase between now and the end of the year. But if anyone has any questions, concerns, any feedback, feel free to let us know. Thanks for listening.